Really excited about my next guest, Stephen Bregman, who is the co-founder and president of Horizon Kinetics. I want to talk to Steve about two things. The first thing is inflation and how to invest in an era of secular inflation. And the second thing is passive investing and how the rise of passive investing, which now dominates the markets, shapes market structure and really creates risks and opportunities that maybe not a lot of people are aware of. Stephen, welcome to Forward Guidance.
Used to be here. I enjoyed our preparatory talks, so I hope I'll enjoy this one too.
Yeah. Stephen, let's start with that second topic, passive vehicles. Could you just quickly describe what is a passive vehicle and how it would differ from a sort of active vehicle?
Well, active vehicle just means an individual account or a fund like a mutual fund, like your granddad had or your dad, which is someone or some team is individually selecting stocks on the basis of some variety of combinations that of valuation or growth or management quality, whatever they happen to think makes a good investment. They're active managers. They're making so-called fundamental decisions based on various facts at hand having to do with business quality and valuation. Passive investing is your current model, the preferred mode of investing. It's the way most investing is done now, which is a fund that doesn't make any active decisions whatsoever other than by a very simple rule set that's established at the beginning via a certain index. So the S&P 500, for instance, is the most well-known index. It's 500 stocks, and they have certain weightings. The largest companies in the index, like Microsoft, might have a 3% weighting or 4% weighting or 5% weighting, and the smallest might have, believe it or not, 1/100th of 1% weighting. And it's just a fixed number, and it's just an algorithm. So if more money comes into the fund, instead of an active manager selecting, saying, you know what, I like that little 0.1% weighting company. I think it's a little cheap. I don't think enough people know about it. I think it's an up-and-comer. I'm going to buy some more of that. The passive index, the ETF algorithm, simply buys exactly in their precise proportions all 500 stocks that are in there. And it doesn't care about valuation. It doesn't care about management quality. It's just a very simple rule set. So you just want to participate. The idea is just to participate in the market. And one last thing I'll say about it, the animating idea behind indexation through a fund was actually put in place by Jack Bogle, the founder of Vanguard. And what he did at a certain point, many decades ago, was get together a fund that would buy all 500 stocks in the S&P 500 in proportion to their market values, the relative sizes. And at the time, people didn't even think that was possible. We didn't have the kind of computing power we did now. They asked, could you even do that? Can you price that every day and have it work out? And he did. But the animating idea behind that was that you don't need to do better than the stock market does, than the index itself. That's what active managers presumably strive to do. Well, that's not necessarily their job, but it's presumed to be. You just want to participate. You don't need to do better. You just want to participate in the results over time of the index. And so if there's, I'm making up a number, if there's $1 billion of stocks out there, and you put your $1 in there, you're not changing anything, you're just participating, and you'll take what the market gives you. And the advantage was you could pay a lower fee because there's not that much activity is going on. That was the original idea. And what you're really asking me about, I think, Jack, is that indexation has gotten so big, so much money has come into it. The question started to become, is the indexation or the ETFs, is there so much money in them? Are they actually changing the prices? You're supposed to just participate in the flow without changing anything. But what if you're buying so much of all the stocks out there that you're actually changing the prices? So in that sense, is the price of the index not being determined by the marketplace, kind of the clearing price between buyers and sellers, all having different ideas. If it's being mediated by the index itself, in other words, by index funds, then, and they don't pay attention to valuation, money comes in, they just buy. Can you get distortions? What are you really buying? That's been a great debate. I think that debate's kind of, well, it hasn't really ended, but we think it has. We think the debate has ended. We think that indexation has gotten so big, yeah, it's distorted the marketplace. It's dangerous. That has bubble-like characteristics. That's been our concern for some time.
So, right. So passive vehicles, they do have benefits. They can be low fees, and they offer people an easy way to access the market without having to monitor and manage all of their positions themselves. And, likewise, human beings have emotional foibles, so they'll get into some very popular stock at the top and sell at the bottom. So they have those advantages, but you just said that they create structural imbalances. Can you talk about, in particular, the indiscriminate buying, that when you buy, let's say, one share of SPY, that goes into everything and it's not really thinking? How does that, can you just go into some detail on how that creates the market dislocations, and to what degree, as you mentioned, is it in the process of sort of creating a bubble?
Keep in mind that it's like too much of a good thing, right? So again, if when we first started writing about ETFs and their potential impact on the market, I'm going back probably 15 years. At the time, I recall our first review of it. During that period of time, maybe ETFs accounted for about 2 or 3% of all equity AUM, as we say, assets under management. But just a couple of years ago, they passed 50%. It's been a long experiment. So if you're just 3% of the marketplace and you're buying a few extra shares of various stocks because they come into an S&P 500 ETF, and it has to promptly, meaning that day, buy them, okay, you're not really changing anything. But what if you're now over 50% of all the assets under management, and you buy, some more money comes into the ETF, and you're buying those stocks? Here's a weird thing. If a stock is the largest component of the index, let's say it's got a 5% weight, and therefore money comes in, you're going to put 5% of the money into that, and you're only going to put like 0.1% of the money into the smallest member of the index. So you're putting more money into the largest position and buying relatively more of it. If your buying power now, because you've more than 50% of the market, maybe there are fewer and fewer shares of that company available. What if you're buying as an ETF, as an index, as a passive investor, actually pushes the stock up a bit? Makes it more expensive. So as it becomes more expensive, you then, when more money comes in, you have to buy yet more of it, because now it's a 5.5% position or a 6% position. It can become kind of a self-reinforcing cycle where the index itself, passive by definition, but in practice, is actually being more active than active managers, pushing the stock up. Weird, isn't it? And on the other side of things, what if the stock falls and gets cheaper all of a sudden? Let's say they had some kind of kerfuffle at headquarters. So someone went on vacation and never came back in the finance department. But it might be a passing. But the point is, because it's lower, the index now has to sell it. The index can help push it down. Again, it wouldn't matter if the index were $1 out of $1 billion, but now it's over 50% of the total. And indeed, if one looks at the year-by-year flow of funds into ETFs, they've been getting bigger every year for 20 years, pretty much. And this year to date is an all-time record by just a huge degree. I think in 2020, which was a new record, there might have been $500 billion of net new funds going into indexes. And this year to date, I think we're over 800 billion. So that's constant flow of money. And ultimately, there can be some problems. There are already some interesting distortions that have occurred. Um, um, Not least of which is that, and this is a subtle thing, there's so much money in indexes now that they can't actually, they're too big to buy and transact in any but the largest companies with the most trading liquidity, where you can buy millions of shares a day. And therefore, the let's call it the number of securities they can buy has shrunk and shrunk and shrunk. So the top, I think the top 10 or so largest companies in the S&P 500, as weird as this might seem, they have the same total market value as the bottom 400 plus companies. So, so what happens is people think the index is a diversified exposure to the broad economy. That's what it was originally intended to do. But today, you've got this crowding out effect of the largest, these so-called mega cap companies. We'll call them the $1 trillion club, where they have $1 trillion market values. So the top 10 have the same total market value as the bottom 418 stocks in the S&P 500. So the S&P 500 is not really diversified anymore. It's not giving diversification. In fact, I gave you some very, very interesting examples of how people are inadvertently misled. That's just the annual inflows, net inflows into ETFs. And basically, money's been flowing into them every single year, bar none. Even when the total stock market went down. How did that happen? Because money's been flowing out of actively managed funds and going into these. So in terms of prices being made on the margin, there's an idea, and it's a true one, which is that it's the marginal trade. Could be 1 million shares traded of a certain stock during the course of the day, but it's the last 100 shares, right, that determine the price. And if the last 100 shares was a buyer paying more, the price went up. So for the last 20 years, since indexation really started, but certainly the last 10 when it got bigger, the marginal trade every single year, in a sense, has been a net buyer by the indexes. And money has been coming out every single year from active managers, actively managed mutual funds and other individual account managers. And so they've been net sellers. So the kinds of stocks that active managers own have been subject to constant sales. And the popular stocks, the ones at the top of the indexes, which the indexes own and buy more of because more money's coming in, they've been the marginal buyer. Now, this very month, meaning a week and a half ago, I was asked to review somebody's 401k, take a look at it and see if I had anything interesting to say about it for the person. And it's fairly a large account, and it had what would be considered a pretty standard diversification plan. And no doubt any person who reviewed it would think it's probably pretty rational. And I looked at the 5 largest fund holdings. They're all index funds. And I knew pretty much immediately what was in them. But for this person's benefit, so that he could understand it, I made a couple of charts for him to show him this difference. He had the Schwab Strategic Large Cap Fund, which is pretty much the S&P 500. He had the Schwab U.S. Dividend Equity Fund, which is more higher dividend-paying blue chip kind of companies. He had a financial sector fund. He had the core MSCI EFA ETF. That's the major international ETF. EFA stands for Europe, Asia, and Far East. And for some reason, they also had the Germany ETF. And I presume the idea is that you want to have some international diversification, right? Generally speaking, and maybe Germany was particularly inexpensive. I don't know, but If you look at the Germany ETF, I just took that one, and you actually knew what the results would be. So the 10 largest holdings are 64% of the fund. So first of all, it's not actually diversified. That's what indexation is supposed to give you. The original S&P 500 mutual fund was pretty representative of the kind of the broad diversification of industrial profits by sector throughout the economy. So this is pretty concentrated. Nothing wrong with that per se. But now look at the total sales of each of these top 10 companies that come from outside of Germany. And basically, something like 80% of the sales of all of these companies come from outside of Germany. Now, isn't that something? So you want to invest in Germany, and you're actually investing in not Germany. Because why is that? Well, these are very, very large companies. And there's so much money in ETFs and index funds that they really can't afford to, if they try to buy some of the probably many interesting local companies in Germany that get substantially all of their earnings from Germany, it could be very interesting. It might be very cheap. But if the index had to buy, let's say, a 0.5% position or a 0.25% position or a 0.1% position in them, it might overwhelm them. They might become the largest shareholder of some of those companies. So they can only afford to own something huge. Basically, what are these? They really have something in common, which is that they can all be characterized as large cap or mega cap global multinational companies. That's what they are. And in a sense, if you think about it, how much different is buying, Bayer than buying Merck? Or how much different is buying Daimler-Benz than Ford? For instance, what if you were to decide as a U.S. portfolio manager, I would like to have more in outside of the United States. So I'm going to sell some of my Coca-Cola, and I'll buy some Nestle's. Well, you know what? It turns out that Nestle's gets more of its revenues from the United States than Coca-Cola does. So you've just increased your exposure to Nestle's. Because Nestle's is not really a Swiss company other than by virtue of where it's incorporated. It's really a global multinational. And I dare say if Nestle somehow committed some kind of corporate crime or malfeasance that the Swiss government really didn't like, and it forbade them from ever selling another chocolate bar or tub of infant formula in Switzerland, I don't even think it would be a rounding error on their income statement, because what's the population of Switzerland compared to the world? It's a rounding error.
Right. When portfolio managers or asset allocators buy a Germany fund, they're saying, okay, X percentage of total holdings are allocated to Germany. So that's corresponding to the economy of Germany. So when the German economy is running hot, Daimler should do well. But you're saying if only a small fraction of the sales are in Germany, demand ultimately is what matters. So it is extremely dependent on the economic conditions in other countries. So it is nowhere near as diversified as it appears.
Yes, it's basically relatively indistinguishable from all the other global multinational companies. So in this fund, and a lot of people have it, in this 401k is the MSCI EFA index. It's the major international index, and the various ETFs that mimic it or mirror it. So Coca-Cola is a top 10 holding in it. And Coca-Cola and Pepsi together are right next to each other among the top 10 holdings. And Nestle's is the largest holding in the MSCI index. But they're pretty much the same. You're not really being diversified. It's only semantic diversification. So the problem is that people might think they have diversification against risk, or that Europe will go up while U.S. is going down, and it's not really so.
So that's one aspect of diversification. Another one is economic or sector diversification. Can you talk about what the S&P 500 or other indices looked like in terms of their, a percentage was utilities, a percentage was technology, a percentage was energies, and how it has evolved over time? In particular, you've noted that the composition of the S&P 500 of energy stocks as well as gold miners is extremely small. And of course, both of those stocks, to some degree, in a rough sense, benefit from inflation. So if we have a huge run up in inflation, then the S&P 500 might be poorly poised to handle
More
that.
poorly than has ever been the case in its history. There's actually been a crowding out effect. But yeah, actually, before I get there, just to go back 1 second to the whole weight of money of all these inflows into the indexes, and the idea that the indexes, they're just simple rule sets. Money comes in, they buy more of what they got, period. So if that's the case, and they're all buying the same kinds of companies, what's happened is, not only because of this factor, but it's one factor among others, is that the returns amongst different nations, in terms or different sectors geographically, have been converging over time. That's not the only reason. Probably a more important reason, or at least as important reason, is that interest rate policies by the world central banks have also been converging in the last 10 and 20 years. And differences in monetary policy dictated a lot of the differences people saw between economies. So Spain was going up while Italy was going down, while Germany was flat and America was doing something else. But the whole world is, in terms of the major economies, all the central banks are doing the same thing. And they've brought interest rates lower and lower and lower. 20 years ago, at the beginning of the modern indexation boom, starting with the first ETFs, iShares rolled out the whole bunch of the first ETFs. So 20 years ago, interest rates were, 10-year Treasury note was 6%. And more or less we've gotten down to these artificially low, near zero rates. And that's been happening worldwide. So that's another reason that returns have converged. But in terms of the debate about, I'm going to play a little game with you. It's not a fair game. It's fixed. The audience knows it's fixed. I originally wanted to do this with you without showing you the exhibit first. And I was going to ask you to guess. And I would have told you, look, there are no wrong answers. Just take a guess, even though you're pretty well studied, and you probably would have gotten some right. But I was going to ask you to guess, now that there have been 20 years of index returns, ETF returns, the debate over whether they are much, much better than active management or not, that question's been answered if you think 20 years, 2 decades is sufficient time. So don't show this slide yet, because maybe the audiences will guess along with us. I don't know. Or maybe it'll just be irritating to them. So let me just describe, before we ask for annualized return figures, last 20 years, for a variety of different classes of ETF sectors. Consider just how good the last 20 years has been for stocks. Okay, so if we go through it, if you think about it, the first iShares ETFs came out in mid-2000, year 2000, and what do we have in this last 20 years? We have, amongst other things, a 10-year plus bull market from March 2009 to January 2000. And if you might decide it's okay not to count the 10-month pandemic drop, because the S&P fully recovered between January of 2020 and November, then it's a 12.5-year bull market. You have the rise of mega cap companies like Facebook and Amazon and so forth. You have the rise of the information technology and social media companies, which are the most profitable, margin-wise, as well as in pure dollar volume of any large companies in history. You've got the consistent ongoing decline in 10-year Treasury yields from 6% in mid-2000 to about 1.4% today. And that's beneficent not just for valuations like PE ratios, those going up, but it contributed to net profit margin expansion because companies could continually refinance their higher cost debt, replace it with lower cost debt. Think of the tremendous amount of share repurchase activity that's been written about so much in recent years. Think of all those manufacturing efficiencies that was vanguarded, in a sense, by Apple's global supply chain development. They were like the first and the best at it. And by the workplace,
So was that an accidental pun, Stephen? Vanguarded?
yes, and very good. And by the workplace efficiencies that would have been enabled by all the information technology companies, data processing apps, cloud services. And think of the decade, give or take, of declining commodity costs, meaning declining raw material costs for businesses in the S&P 500, all the consumer products companies. So just take Coca-Cola as one example. It benefited over 10 years from lower sugar costs for its syrup, lower aluminum costs for its cans, lower diesel costs for its vast fleet of delivery trucks. And in fact, the cost of delivery trucks has been a benefit to Coca-Cola and or its bottlers, because between 2000, at the beginning of this era, we'll call it, and 2020, I understand the average inflation rate of new car and trucks rose by an annualized 0.18% a year. So basically, that's a benefit too. So that's the background, and it helps you understand why we now have record high, and we think unsustainable, profit margins for the S&P 500s, for the S&P 500 companies. So now, with that as the background, if you hadn't looked, and if you didn't know, because this is what you do for a living, like what does someone think the iShares? I use the iShares because they have a consistent methodology across all of their funds, and they have the whole range of funds, and they were the earliest. So they're a natural place to go. I'm not picking on them. They're actually a resource. The iShares Core S&P 500 ETF, it's been around for 21.4 years. It started in May 2000. What do you think the annualized return has been?
Okay, so I really like this game, and full disclosure, I looked at this because you sent it, about an hour before we started. But I do not. I honestly, I do not actually remember it.
Great.
And while you were talking, I was resisting the urge to do it. So, but like you said, I have been studying markets and interviewing. So let's see. I know 2000 2008 net was pretty much a push.
Okay.
But 2009 to now has been so good. So I think it's been pretty good. 12%.
I commend you for doing this honestly. And frankly, that's not a bad guess, which is why this game is so fun, at least for me. So the answer is 7.2% a year. Not so hot. And I'll bet nobody who, unless they've studied the numbers, would really know. So now let's go for some variation. The Russell 1000 growth, the iShares Russell 1000 growth ETF, that's a big one, IWF. It started the same week, May 22nd, 2000, 21.4 years. Now that's more or less the growth component of the stock market, of the large cap companies. What do you think? So if 7.2% is it for the S&P 500, what's it for the growth stocks?
Okay, so I think the small cap growth is sort of getting it from both ends, because from 2000 to 2005, growth did really badly.
But this is large cap. This is the Russell 1000.
Oh, Russell 1000. Oh, okay. So it's Russell
1000
growth.
growth.
Oh, so okay. So
Russell
I think it will be
1000
higher.
growth.
Like,
yeah.
Growth. Okay. I think it will be higher than the S&P because past 10 years really good for large cap growth. So, 7%.
7.18%.
Okay.
The S&P 500 was 7.21. Now let's go for the iShares Russell 1000 value stocks.
Okay. 2000, 2007, pretty good. 2007, 2021, not good. I'm going to say 6%.
7.3%. They're
Okay.
more or less the same, basically. 7.2, 7.2,
Yeah, okay.
7.3. Now, iShares Utilities ETF, utility stocks. Those aren't growth stocks. I'm going to just give you the answers. Maybe some will last a 7.28%. iShares US Technology ETF. There we go. iShares US Technology ETF. How'd that do? Started May 2000.
I'm going to say 8%.
Yeah, 6.7. iShares Biotechnology, 8.1%. Okay, so let's go to international. iShares MSCI EFA, Europe, Asia, Far East, the major international. That started August 2001, but it's 20.1 years.
I'm going to say not great. I'm going to say 4%.
Very good, 5.7%. iShares MSCI India, 7%. iShares MSCI Brazil, 5.1%. iShares MSCI Emerging Markets was actually 10%. There could be reasons for that other than what we think. And if we went into the reasons for all of these, they're interesting subtleties. But the idea is that these are remarkably the same. They're remarkably the same. And where's the diversification? Where's the growth? There are reasons, but we don't need to get into that. I'll just make some general fuzzy comments that too much of a good thing. The weight of money, supply demand is the magic formula in prices in any kind of human market. Whether you go to the souk or you're buying cars or you're buying stocks. And to not realize that is to really miss part of the important bigger picture. Um, um, it pays to understand that what you're indexing, that indexing has changed. It's very success from a Wall Street standpoint, meaning gathering lots and lots and lots of assets to buy the same product. It's having, I believe, it's having an effect. Now, where you wanted to get to is one of the other effects, which you were naming before I took you on the side journey, is this crowding out effect. So if the top like 7 largest names in the S&P 500, which I think are all information technology companies, if they alone account for 25% of the value of the S&P 500, there's a certain crowding out effect that's happening. So other industries become pushed down, and maybe some of those industries and companies, maybe they might do well. But if they're a smaller and smaller part of the index, if they do well, they might not help you very much. And they represent different opportunities. So energy is the most obvious one. So the energy sector, and there's a historical chart on this. The energy sector in the S&P 500 traditionally would vacillate somewhere between 6% and 15% of the market value of the S&P 500. And that probably represents in some rough way the contribution of energy to the total economy. It had its bubble periods too. By 1980, energy had gotten to be near 30% of the S&P 500. But even not more than several years ago, it was about 6%. It is now less than 2.7% of the S&P 500. It's never been this low. ExxonMobil all by itself was once a much larger than that as a percentage of the S&P 500. Now, what are the implications of that? One of the important implications, because again, remember, indexation is about risk, partly about risk control. You want to be diversified across a wide variety of industries and companies, so as any single one won't really harm you, but otherwise you're participating in the long-term growth of corporate profits in America. That was the idea. So it's clear that one important potential vector of inflation is oil, energy prices. Why? Because it's the most critical commodity. It's in everything. It's in everything from heating oil to gasoline to, you can't make plastics without it. It's in everything. So if the price of oil goes up a lot, there's going to have an inflationary impact. When it has an inflationary impact, there are lots of different companies or sectors within the S&P 500 that will suffer, because a business with a lot of a fleet of trucks will have to pay more for transportation. They'll have to pay more for plastics if plastic is an input in what they do, if they're a chemical company, if they're a manufacturer. So they might suffer in terms of margins and valuations. And the idea is that if you have a traditional 6 or 10 or 12 or 16% weighting in energy in the S&P 500, and that doubles, well, that can offset a lot of the losses you might have in other sectors. But at not much more than 2.5%, energy can no longer really help you in the portfolio diversification sense. But let's take that and go a step further. What other inflation beneficiaries are there in the S&P 500? Because there are other vectors of inflation. For instance, critical metals. So right now, there's an awful lot of activity building renewable energy sources like solar panels and wind turbine farms, and they use a lot of copper, a lot of silver, a lot of nickel, and so forth and so on. So let's just see. What is the weighting in the S&P 500 of gold, traditional inflation hedge? Really, it's better as a dollar hedge. But it turns out that the sum total of all of the gold mining companies in the S&P 500 is one company. It's Newmont. It used to be called Newmont Mining. Now it's called Newmont Corp. It's a big company. It's got a $45 billion market cap. And I know I asked you this to guess last time we spoke because I wanted to be cute. Like, what is the weighting of Newmont in the S&P 500? And the answer is 11 basis points. That's Wall Street speak. In human speak, it's 11 100ths of 1%. The only other mining company, let's say non-gold or silver, non-precious metals in the S&P 500 is Freeport-McMoRan. It's the second largest copper miner in the world. And it's got a $55 billion stock market value. As big as that is, it's gigantic. It's 14 hundredths of 1% weight. That is it as far as precious metals are mining the S&P 500. Now, there's a materials sector, and people might think that's an inflation hedge, but it really isn't. Maybe other than a short-term basis, because those are mostly chemical and paper and packaging companies. And their costs, including energy, their energy costs, they do a lot of heating, go up substantially during an inflationary period. They're not inflation hedges.
So wait, are you saying that the only the only copper mining stock, or one of the very few, is Freeport-McMoRan?
The only one.
And the only one. And that, so when I think XME materials, I sort of assume. See, even I'm surprised. See, I'm familiar with your thesis, so I'm sort of protected from some of the shock. But I'm surprised that when I think XME, I'm thinking stuff being taken out of the ground. But you're saying that the only copper miner, the only copper thing there is Freeport-McMoRan.
Those are the only two miners whatsoever. The gold mining company Newmont and Freeport-McMoRan, the copper miner. And by the way, we haven't gotten into this yet, but there is a structural long-term shortage of capacity in mining, whether it's precious metals or industrial metals. So there was an interview 6 months ago with the CEO of Freeport-McMoRan, and he was asked about it. We need a lot more copper because you need it for solar panels. You need a lot more silver paste is used in solar panels and for the wind turbines. And he said, look, if we started today to try to expand our production, because they've spent the last half dozen years at least reducing their capital expenditures because copper prices were so low. And for the last half dozen years, gold prices and silver prices are low, last 10 years or more. So if energy prices for the last 6 or 7 years are too low, and the energy companies have been cutting their capital expenditures every year. They're now spending 50% less than they were 10 years ago, 6 years ago, 7 years ago. So he said it would take us like at least 5 or 6 years from us if we tried to start today to really produce a lot more copper. And meanwhile, demand is increasing. So you can see how the price of copper and the profits of a company like Freeport-McMoRan or Newmont Mining might go up a lot because they're not producing enough, but there's more demand for what they've got. But you're not going to benefit from it. How can you benefit from it even if they quintupled? If they quintupled, they'd go from 11 hundredths of a percent or 14 hundredths of a percent to 3/4% in the S&P 500. It's a rounding error. You wouldn't notice it. You get no benefit from it. So in essence, in a nutshell, the indices have lost a lot of their natural resilience to various kinds of insults or stresses because of this crowding out effect by what we'll call the mega cap companies that dominate the top of the index.
Yeah, that's so interesting. And also, if Newmont goes from 11 basis points to 44 basis points, and inflation's running hot, the Salesforces of the world, the DocuSigns, I don't know if that's in the S&P 500, they might not do so well. So what has been working may not work in a new environment. That's leads to my next question, Stephen, which is isn't the reason that Apple is a huge part of the S&P 500 just because it has worked? So hasn't it earned its huge spot? Like, wasn't it the case that there were copper miners that were part of the S&P 500? They just did not perform. So to make shelf space for the stuff that is performing, or it is high enough market cap, I guess, it was booted out. And to what degree do you think that's merited? Like, so let's say you are running a company and you're running a sales team, and I'm on a sales team of 10 other people, and you're giving leads to the salespeople, and I'm getting very, very low sales, and the person next to me is getting tons of sales. I might not be pleased when you give me fewer leads, but to what degree is it sort of merited?
Merit is a strange, because we're anthropomorphizing the stock market. And the question is, as an index to serve people who aren't professional analysts and investors. So you come in new. You come in new to the index. This is one of the classic problems with indexes. And it's nobody's fault. It's the way you have to make choices when you construct an index. You come into the index today, and all you know, it's supposed to be a diversified index, the S&P 500. And if you don't so-called look under the hood, you might not realize that what you're really investing in, that 25% of your, more than that actually, because we're just talking about the top 7 companies, right? But 25% of what you're investing in right now are mega cap information social media companies, right? And you might not realize that. And you might know it, but you might think they're great companies because you hear they're great companies. But no knock against them, but as a product of their own success, okay, they have very, very large, here are risks. And I'm not saying they're not going to do well, but here are risks one should be aware of as an investor. It has to do with business models, how things work. So if you've got, like Facebook, for instance, Facebook has a very, very large market share of whatever its market is. Not that there can't be other growth opportunities, but it is necessarily a lot closer to saturating its market, to being mature, than it was 10 years ago, and 5 years ago, and 3 years ago, and 2 years ago. At some point, it's not a knock against it. It's actually as a function of its own successful management and its technology, its creativity, the growth will have to slow. It happens. Microsoft's market share, at some point, its growth will have to slow. And therefore, they are closer to the end of their growth phase than they were a few years ago. As a product as well of their success, they also have very, very high earnings multiples. Really way, way, way higher than businesses tend to deserve when they start to get mature. So what if you own this for a few years, 25% of your money run into these immediately as soon as you went to the index. And in 2 or 3 years, people see those businesses are beginning to slow. So that whole portion of the index begins to suffer some valuation PE multiple contraction. Doesn't even have to be a lot, a little at a time. I remember Walmart back in 1995, 94, when I worked at a bank, a private bank, and I was on a committee that selected stocks to be on the list that all the other portfolio managers would buy. And one of our analysts was promoting the idea of Walmart. We should buy Walmart. And he said, look, they're growing 30% a year. They have a PE of 30. That was supposed to be a meaningful identity. And they keep expanding.
Yeah, I should say that PE's price to earnings ratio, and at the time, 30 would have been considered quite high, right?
A way of rephrasing that just slightly is saying you're paying 30 years worth of earnings, right? For every year worth of earnings, you're paying 30 times each year's earnings. Anybody who's ever been in private business, you bought an auto dealership, you bought somebody's retail store, you bought their construction business. Any private business you've ever been in, you'd be lucky if you ever see a business, a non-publicly traded, not using OPM, other people's money. A business owner hardly ever pays as much as 10 years worth of earnings for another company. They're thinking, okay, if I pay six years worth of earnings and I'm earning some of my return back and there's some risk here, but they don't pay that much money. In public marketplace, we do. So we'll accept that differentiation. But I told them, I said, look, it was a question. I said, but it's wonderful, but look how big they are now, right? They're in every state. They have so many stores and so forth. But what if their growth slows to like 28% a year from 30% a year? I said, most CEOs, they would actually let their left pinky be surgically removed if they could have 28% a year growth. But to this company, it would be a slight disappointment, no warning bells, but just people pay a little less for it. The PE might contract to 28 times earnings. And what if a few years later, it's only 25% growth, and the PE contracts to 25, and then it's 18. 18 is wonderful. Most companies would love to maybe a CEO only let his hangnail be removed if for 18% growth. But the point is, I said it could be like going up a down escalator because the company will be becoming mature through no fault of their own, actually as a complement to their great management. But they're going to saturate their market little by little. And in fact, that's exactly what happened. You take a look at a chart for Walmart. It was flat for like maybe not 20 years, but at least 10 years, as it slowly slowed and eventually ended up at the kind of PE ratio that is generally paid for a publicly traded, decently managed retailer, which 15 times earnings. And that's not a disaster. But at the very least, you should know that that's a characteristic of what the S&P 500 looks like now. I could talk about other risks, but it's certainly undiversified. It's top heavy, and has certain risks. But as well, the point I really wanted to make is it's been stripped of its resilience because it's the crowding out effect. That's one of the implications of and the last implication of what's happened to indexation has to do with having passed the 50% mark in terms of publicly traded equities in the United States of America. A couple of years ago, they passed the 50% mark. And so this has some interesting implications. There are a few of them. So one is, what if you control the S&P 500 all by yourself? And you had this discussion, you were listening to the discussion between you and me, and said, you know what, I'm not worried or anything, but I would like to rebalance the S&P 500 a little bit and take a little bit out of information technology and put a little bit more into energy. Maybe energy should go back to 12 or 15%, and I'll reduce the information technology by about that much, and it'll be better again. All I want to do is rebalance. Well, simplistically, it's easy to do. You just write the computer code. You adjust the rule set for the ETF, and it does it. But in terms of actually implementing it, you might not even be able to do it. Because first, there's no longer enough money being actively managed to accommodate that. So like, if you have more than 50% of all the money, and we're talking about trillions of dollars, and you want to sell your leading positions, who are you going to sell to, even if they want to buy them? Once upon a time, when indexation was 10% of the market, or 20%, 30%, say, okay, there's a big enough pool of capital to buy it. But now you're the largest pool. Okay. And second,
well, Stephen, so there's always a price, right? So if there are way fewer active managers who are willing to buy it, the prices will just have to go down, and then there'll be opportunistic fund managers say, yeah, Apple at $90, I'm in, right?
Oh, you're ahead of me. Okay, you're ahead of me. Because my second question, thank you for taking my thunder, but
Sorry.
You're allowed. No, because you're doing an excellent job. So the second question is, well, why should they? Right? Exactly what you're saying. So yes. So the terms of trade will change, meaning that at some inconvenient moment, Why would an active manager want to pay 35 times earnings or whatever the PE is for Amazon? Maybe they want to pay 15, which is what they remember Walmart went to once upon a time when it finished its growth phase. So you could have a discontinuity there. Or the point is, you couldn't even find a buyer. I mean, a buyer for your stock. And third, which is a more subtle problem, is that the other side of it, you want to add to energy stocks. There might not be sufficient market value or shares available for you to buy. To make the example easier, think again of the gold mining industry, which is just 0.11% in the S&P 500. Or what we just did, add up all of the real inflation beneficiaries in the S&P 500, you get to like 3%, 3.5%, maybe. You can't, if you want to buy that stuff, you'd blow them up. I mean, meaning there'd be a discontinuity upwards. There's not enough liquidity. So the index has gotten to a very interesting, unbalanced kind of state.
Stephen, now that we're familiar with your core thesis, could you take us a little bit into the weeds on how the crowding effect works? So as many people may know, there's this meme stock phenomenon that began in December, January, and a company called AMC, a movie theater chain that had struggled a great deal in terms of the business over the past 10 years. Very rarely making money, low margins, having to take on a lot of debt, not a growing business. And as such, AMC was down a tremendous amount. However, when AMC surged from $4 to $60, I should say AMC was part of the Russell 2000, the IWM. So AMC was a small fraction because it's a small stock in a small stock index. But as it surged, many hundreds of % it came to be and still is the largest weighting in the IWM. To what degree does AMC now benefit from being the top dog in the IWM, Russell 2000, as the same way that the Apple benefits from being the top dog in the S&P 500?
This kind of art imitating reality and vice versa. You can have these effects in the stock market. So I didn't follow this particular case very closely, but yes, you can be saved from let us just say a deserved failure because you didn't manage your balance sheet well, or maybe just circumstances overtook you in the securities markets. If your currency, which could be your common stock or your cost of debt, if that's the problem, suddenly are priced in your favor. So I don't know what happened with AMC, but I would imagine if I were the treasurer of AMC and the CEO hadn't thought of it, I would certainly tell her, hey, I don't know if you looked at it, but in the last 48 hours, our stock's gone up a lot. We need to sell a bunch more right now. So art becomes reality suddenly because people believe, for whatever reason, they traded your stock up. How even if it's completely lacking in any kind of fundamental basis, it becomes fundamental because now you can sell a bunch of stock, you turn it into cash, and that you get to keep. In the same, in a much more, in a broader, more structurally important sense, part of the reason we haven't discussed this yet, but it's part of the inflation risk that's facing all of us, maybe for the next 10 or 20 years. The Federal Reserve's easy money policy, some would say profligate, some would say dangerously loose money printing policy. Let's just say it started for real in the wake of the financial crisis, right, the 2009 period, because they really should have and did provide liquidity to the marketplace so that the economy wouldn't collapse. Companies needed liquidity. The borrowing market for the bond issuance market just froze. Companies couldn't roll over debt, even perfectly credit-worthy companies. They rely on the markets working so that when some debt comes due, they roll it over because a banker should, because it's a credit-worthy company and they can pay their interest expense. So they did. So they flooded the in various creative ways. They flooded the market with the marketplace, the financial markets with liquidity, cash. And then after that, they were supposed to stop, but they didn't. And so they kept interest rates low and lowered them some more and lowered them some more and lowered them some more. And in the same way that AMC might have been at least temporarily rescued by a bunch of people, let's just say accidentally pushing the stock up, and AMC could turn that higher stock price into cash. Well, there are companies that every credit analyst would have told you should have failed, or deserved to fail, because they were debt laden and they shouldn't have been, and they made bad choices, but they stayed alive. You could examine any of the high yield indexes. There are ETFs for that. One has an appropriate symbol, JNK. But what happened is, as interest rates kept coming down, so one of these companies had 8% debt. Well, they could sell some 6% debt now and pay off the 8% debt, and now they saved that much interest expense. And then they could do it again the next year, and they could issue 5% debt, pay off the 6% debt. And so they were able to stay afloat and keep going through no fault of their own because the Federal Reserve gave them that opportunity. And so that ended up becoming reality. So a lot of those companies are still around, and maybe they've thrived, or maybe they're just still hanging on. But that actually gets into the debt problem we have in this country, because we are over indebted to a degree that's never happened before in our history. It's scary high debt to GDP. And it's masked because interest rates are so artificially low. The interest expense on that debt doesn't seem that, the total interest expense doesn't seem as high as it would otherwise. So some of those junk bond companies, let us just say, what they should have done is say, wow, saved by the bell, and now I'll just pay down my debt because I've got lower interest rates. I can refinance lower. I can save some money. I'll use that money to pay down more debt. But too many of them, maybe most of them, didn't. They just maintained their debt load and just benefited from the lower interest expense. Maybe they took on more debt and kept their interest expense the same. So they didn't become delevered, as we say, or have less leverage. They kept it there. They might even have gone higher. And that's what's happened to our economy. And that, by the way, in a strange way, having more debt is also inflationary. Just like too much money is inflationary.
Stephen, I've often heard the case of that, the exact opposite, that debt is deflationary. Economists such as Lacey Hunt. What's your case for why it's actually the opposite and it's inflationary?
The total debt in this country is $85 trillion. Federal debt's $29 trillion. So when I say total debt, that's everything. It's the federal debt, municipal, state and local. It's mortgage debt, credit card debt, auto loans. Okay, it's $85 trillion, and the average interest cost blended is 4.1%. So, what would happen if the Federal Reserve were to let interest rates rise by just 2%? It doesn't seem like a lot on its face. I mean, right now the 10-year Treasury note is about 1.4% yield, and not that long ago was 6%. It's a normal rate. So historically, so that means that we're just bringing the 10-year yield, for instance, to 3.3% instead of 1.3%. Okay, so here's how that can be inflationary. Well, first, I just want to give people a sense of how devastating that would be to the economy now, just how leveraged we are as a measure. Let's just say, for simplifying purposes, it doesn't happen this way, but that the yields for all the different forms of debt went up by 2 percentage points across the board. And I can't do it right away because you have 30-year mortgages. Those aren't going up right away. But you have some auto loans, those roll over pretty fast and so forth and so on. But let's just say it went up 2%. Well, we have $85 trillion of total debt. So if interest costs go up 2% and you multiply the one by the other, that's an extra $1.7 trillion of interest expense for the nation as a whole. Now, what does that actually mean? Well, one way to relate it to things is that's almost 7.5% of GDP. GDP is $23 trillion. A significant recession is 3% of GDP, is a 3% drop in GDP. What we call the Great Recession of 2008 and 2009, after the subprime mortgage crisis, GDP went down 5%. So a 2% increase, 2 percentage point increase across the board in the nation's debt, that's a 7.5% decline in GDP, if you look at it that way. But here is a way to look at it that's even less abstract, that people can relate to. The price of oil, okay? And it shows you also how debt by itself can be inflationary, because there's a cost to it. So let's just say, and this is a completely fanciful example, I admit that in advance, but let's just say that that additional interest expense figure of $1.7 trillion, because of a 2% increase in interest expense across the board, were allocated somehow only to oil. That's where it goes. So the U.S. consumes about 20 million barrels of oil a day, and you multiply that by 365 days a year, that's 7.3 billion barrels a year. And if we have to pay an additional $1.7 trillion for that 7.3 billion barrels of oil a year, that works out, you divide one figure by the other, an extra $232 per barrel of oil. Which means, because oil's about 70 now, we'd be paying $300 a barrel for oil. And we know what happens to the economy if oil goes up suddenly to $150 a barrel. Like, that alone causes a recession. What would $300 a barrel do? People's heating oil, their gas, the cost of anything plastic, the cost of delivering food from California to shelves in the Northeast supermarkets. It's basically the economy couldn't handle it because we're so indebted, and the indebtedness has been hidden by artificial low interest rates, which is why we think whatever the Federal Reserve says, they have a different agenda, and I can't blame them. Whatever they say about when they'll ease the tapering or raise interest rates, at the end of such and such a quarter, as soon as a certain measure hits this mark, whether it's unemployment or the money supply or whatever they say, it's always around the corner. They'll always consider it. They're thinking of doing it. And all the commentators and prognosticators, they all talk about it. And so, they're pushing it off a little bit. We'll look for the next meeting. And our point of view was, and it sounded very simplistic, and it is simplistic, is that the Fed will not raise interest rates because they can't afford to. They can't afford to, so they won't do it. Whatever they say. And they're not doing anything, trying to do anything bad, but in essence, they'll string it along, because what the standard answer, it's old wisdom, it's wisdom that's more than 2,000 years old, is they're going to try to debase their way out of it. You keep this up, see, they passed the tipping point, because in order to keep rates low, how are they doing it now? You hear about bond buying and so forth, is they buy bonds in the marketplace, meaning they push the price up, which pushes the yield down, keeps the yield down. But in order to buy the bonds, they have to print money to do it. They're kind of locked into a cycle now where they have to print money to buy bonds to keep the interest rates low, which produces more money. And the amount of debt keeps climbing each time they do it. So there's more interest expense. It's really a very scary cycle. And there might be a tipping point. I think they passed the tipping point where they can't get out of it. So what they'll do is a standard procedure. It's been done for across history, across nations for thousands of years, is they'll play for time. And the way they'll pay for it is by debasing the currency. That's a slightly different discussion, a little more in depth. But the point is, in the 1970s, there was a 10-year period from the 1972 more or less, to about 1982, when inflation averaged 7% a year. I think that was it. Doesn't seem terribly much, but it meant that the cost of living doubled, which meant that until that time, there'd never been that kind of inflation in a long, long, long time. It wasn't in people's memories. And so someone who had accumulated a certain amount of money to retire and put it all in bonds, and they're getting 4 or 5, 6%, whatever it was, they expected to be able to live on it. And they should have been. But whatever they could afford, let's say it was just the right amount of money for them. But by the end of 10 years, that period, 10-year period in the 70s, they had half as much purchasing power. Same amount of bonds. Let's say it was $100,000. They started with $100,000. They finished with $100,000, but it was only worth 50 in terms of what they could buy. Food, rent, utilities. It's devastating. But that's one way out, which is again, what debasement means and how it works is a little bit more involved discussion. But it means that we think it'd be a lot worse in the 70s. We think what's coming up is a lot worse than that, and that it won't just be 10 years, that there are structural elements in place for that. So 10, 20 years goes by, and it can be really devastating. But what happens is the total amount of debt, right, gets cheaper and cheaper and cheaper because there's more and more money with which to repay it. Cheaper money. That's the way out. And I think that's really the path they're on. Now, they can't say that. Can you imagine if you were the head of the Federal Reserve and you said that? There'd be panic.
Bond yield would go through the moon.
You couldn't do it. You can't do it.
Yeah, key to the operation of a debasement would be keeping long-term interest rates significantly below the rate of inflation. So to sort of admit the game and admit their plan, soon enough, perhaps not, but the bond market would catch on. My question for you, Stephen, is how do you explain the 40-year structural bull market in bonds, and why do you think rates are so low? The 10-year, the 30-year, even as inflation is so hot. And if your thesis plays out, where we have, I assume you're projecting 7% or above 7% for a bit. Bonds are bonds going to continue to be at extremely high prices, extremely low yields, despite the inflation that you predict?
Well, the bull market is easy because that started with Paul Volcker, right? 1981 or so, 82. So when treasuries were 16%, had 16% yields, okay, more or less, the world central banks have been gradually becoming more and more coordinated until right this current era now, they're in lockstep. But they've been bringing interest rates down for 40 years. Ergo, a 40-year bull market in bonds. Now, where we are now is on their face. This also is very, very rare, but I don't think it's ever happened before that's been this extended. Is on its face when you buy a bond fund, a Vanguard Treasury bond fund or an investment grade corporate bond fund, on its face, you are losing money on an after inflation basis, on a real basis, as soon as you buy it. Every single day you own it. That's where we are now. Just what you said. So, whatever the rate might be, you might say it's 1.5% yield. Okay. Well, the stated inflation rate, the CPI, is already climbing above 2, 3, 4%, might go higher, which means every day you hold that, you're actually losing purchasing power. That's what's going to happen. So when you say, but bond prices, how can bond prices stay low? Yes, because it's not a real market anymore. It's an artificial market. When the government, with an unlimited pocketbook, steps into the bond marketplace and starts buying securities, that's a false clearing price, right? Ordinarily, it's 1,001, 10,001 different contenders in the marketplace with limited pocketbooks. Some people think bond prices should be going up, some go down, some are taking a look at different credit quality. They're contesting with each other, right? They're bargaining with each other and they're determining the clearing price. When the government steps in to buy, that's now an artificial market. That's what's so confusing to people, I think.
Yeah, and I guess if TLT, the long bond ETF, has about $20 billion of assets under management, the Fed is buying 6 times that in a month. So the Fed is definitely the ultimate
And
ETF.
that's what I'm saying about ETFs. It's the same idea. But you've got a point, which is it's much easier to see with bonds. Because with stocks, there are so many variables. You can argue about the management and the growth and how long the growth will last. You can debate it endlessly. But with bonds, there aren't that many variables. You've got a certain coupon, you've got a certain maturity date. You can say, okay, this is not going to default. I've got pretty good view on that, pretty good assurance. And so you know what you're going to get or what you're not going to get. And right now, you can get 1.5% up front. They're telling you that your cost of living is going up by 3% and maybe rising. The question is, how long will that go on? And will it get worse or will it be transient? I think it's structural.
Mm-mm. If it is structural, Stephen, investors have to think about how they want to allocate. And your firm, Horizon Kinetics, has a very specific way of thinking about investing in assets that will benefit from inflation, not just hedge, but benefit from inflation. I actually had an interview with the portfolio manager of the Horizon Kinetics Inflationary Beneficiary Fund, INFL. Because we've been going on for a little bit, if people want to learn about that, they should just click on the interview, which it's called "Investment Strategies to Profit from Inflation, Not Just Hedge," on the Blockworks YouTube channel with James Davolos. But one particular aspect that James was talking about was that you want firms that their costs, not only will they be able to increase costs onto the people who are paying them, but they themselves are not very vulnerable to costs being increased on them. Like, they already have the assets. So can you speak to an example of the ultimate example of that, which is a company called the Texas Pacific Land Corporation, which has been a mainstay of your firm. Your firm very much is into that stock, and it has paid off. If we put up the chart of it compared to ExxonMobil versus the S&P 500. Yeah, can you elaborate on the principle of limiting the cost and sort of having fixed assets?
So I have to start at the very basics because the best kind of inflation beneficiary company is a business model that does not exist in a sense in the Wall Street consciousness. You won't find them in the S&P 500. They're not studied. And I speak very often to professional investors, sophisticated professional investors. They might be an account exec at a very large investment firm, or even the kinds of analysts who come in to assess us as to whether we're fit to manage some funds for other parties. And when I tell them about this, they're really not sure what it means. So I'll explain it. So that I'll give you an example between a conventional energy company like an ExxonMobil, and let's just, to make it easy, forget that ExxonMobil has refining businesses, chemical refiners. Just they doesn't have to be ExxonMobil, it can be any of them. They dig in the ground, they bring up oil, and they sell the oil. So that's what people think of as an energy company, and it's a natural form of business, meaning they have a lot of employees. They have a lot of property, plant, and equipment. The equipment needed to drill for oil is very expensive. It's very substantial. It has to be replaced and upgraded often. And before you even do that, you have to have a lot of capital just to buy a lease or buy the land on which to do it. So you have to mobilize a lot of capital in order to do this. And then you have operating expenses. So it can be very profitable. Maybe you have a 15% operating margin after taxes, or 10% operating margin, whatever it is. Then there's something called a royalty business model. And a royalty business model is, they don't own any assets. They don't have to drill. They don't have to have employees. What they do is they happen to have an interest, let's say, in mineral rights, in a certain property, certain land. And anyone who drills in that land, they bring up some oil or gas, they've got to pay a certain percentage to the royalty company. Maybe it's 2% or 3%, whatever the number might be. And the royalty company just accumulates it. And they don't have to do anything. Now, how do they get it in the first place? Well, in the case of Texas Pacific Land Trust, they were granted that kind of land. It's almost 1 million acres mostly in western Texas. They were granted that land, believe it or not, in 1888 as a result of a railroad bankruptcy. And so the bondholders, the railroad failed, the bondholders inherited all the land. Here, guys, we can't pay you your bonds, but here's the land. And they put it into a trust. And the trustees of the trust were allowed to do a few things. They were allowed to sell acreage here and there to pay off the bondholders. They were allowed to accept like grazing fees. If any oil was produced on their land, they could collect some royalties on that. 95 or 98% of the land was actually grazed out for cattle. And they could buy shares back. They could pay dividends. That's more or less all they were allowed to do. So they went on for like a century and a half like that and kept buying in shares with their little trickles of revenues. And they kept buying in shares, and it became fewer and fewer shares outstanding. But if you kept owning your own shares, if you didn't sell them, and they were buying back acreage too, buying in shares, and they'd sell some land here and there, but they bought back more shares more rapidly than they sold land. So what happened is year by year by year, over the course of a century plus, you get more and more acres per share of ownership. And it was kind of like an internal compounding machine. And they only had like a dozen employees. So because of advances in technology, starting about 6 years ago or so, some companies began drilling seriously in the Permian Basin. And the reason they hadn't drilled seriously there before is because it's so deep that the technology didn't exist to bring it up in an economical way. But now it's very easy to do. Well, easy with a lot of technology and so forth. So TPL still has, among its various assets, it has interests or royalty interests in a lot of this acreage. So it doesn't matter who it is. It could be Chevron, it could be Occidental Petroleum, it could be Apache Corp. Any of these companies happen to drill in areas where TPL has a royalty interest, TPL gets the royalties. So unlike those companies, let's say up until quite recently, they started a new business having to do with water rights they have. But for a dozen employees, got a $1 billion plus company. And they don't have to do anything but receive the royalties. They don't have to have the capital intensive business. They don't have to have all the employees. They don't have to buy property. They have the property. And their operating margins make even like Facebook or Microsoft's head spin. It's 90%. It used to be 90%. Today it's a little lower because they've got involved in some water recycling business there. But the basic royalty business, basically it's 90% margins. So if you think about what happens, let's say oil prices go down a lot. If oil prices go down a lot, which we saw that happen not quite recently, just as a living laboratory example, ExxonMobil can have losses. Why? Because they have a lot of costs. And oil prices go down too much. They can't cover their costs. They have to fire employees or reduce their spending. They have to tighten their belt. And they'll survive. They'll survive because it's a cyclical market and eventually the price will go back up. Now, TPL can't have a loss. It's impossible to have a loss. Now, it seems a weird thing to say that, as if I'm being careless with my words. But the thing is, their revenues can go down. But that part of the business, they only had a dozen employees, right? So
they have no costs.
But they have no real cost to cover. So their revenues can go down, but maybe their margin goes from 90% to 89%. It really can't go out of business
Right.
in the ordinary fashion. And a royalty model like this, it actually doesn't have most of the classic business risks that all businesses have. It doesn't have any direct competitors. Nobody can replace, in a sense, the royalty interest they have. They have them. They don't have real technological obsolescence. It's not like a technology company where somebody can come along with a better algorithm like TikTok, as opposed to whatever Facebook is. They don't have replacement cycles, re-equipment cycles like car manufacturers do. They're not even subject to interest rate risk. They're not even really subject very much to a classic business recession. They don't really have, in their way, even much in the way of regulatory risk. I think they're the second largest private landholder in Texas. They own their land, and they have their property rights, and they just collect money. So what will happen is, one of the reasons why we like TPL, number one, is inflation. Talk about classic inflation beneficiaries. Inflation on an extended basis is really not so good, believe it or not, for the classic inflation beneficiaries like an oil company or a gold miner. On a short-term basis, yes. As soon as the prices go up, they just get more money, prices higher, without lifting a finger. So on a short-term basis, for a play, as they say in our business, a play, yeah, you do the play right. You buy the gold company or you buy the silver company, you buy the oil company, you do fine. But what if this is going to be more than a year and a half? What if it's going to be 10 years? Well, we've had that experience in the past. What happens is inflation acts upon those companies' operations as well. If you're a gold miner or if you're an oil company, if there's more demand for your product, okay, first you just ramp up production, what you have. That doesn't cost too much. But after a while, you need to expand. So you need to buy more property or leases, but everybody wants to. So you're paying more for that. You need more equipment.
And who are you buying it from?
Yes.
TPL, right?
Well, you wouldn't be buying it from them, no. But
Sorry.
from other parties or leasing from the government. The price goes up.
Right.
You're also competing with others for more equipment. Maybe there are equipment shortages. Your employees eventually want more money. You need a lot more employees. Everybody's competing for them. So your costs begin to rise also, and your margins begin to suffer, even as you're producing more and more revenues. And so you're also suffering from that. Now, in the gold business, that happened to Newmont way back when, is that, yeah, their total revenues are going up over the years, but their margins are beginning to decline. Their earnings are still going up, but people aren't paying that much attention that the earnings are going up more and more slowly compared to revenues. The price gets bid up a lot because it's done so well. Everybody loves it. And then just around that time, so much gold is being produced that there's now a little bit of excess supply and the price falls, just as the company's total expense structure has maximized. And maybe they've taken on some debt too. Who knows? And then the whole thing collapses. Can't happen to a TPL. Can't happen to a royalty company that way. A royalty company is always making money. It's always generating ROE. And therefore, on a financial basis, it can always be compounding. So imagine this. Energy prices go up a lot. TPL is just making money printing it like a mint. Money's falling from the sky. But then oil prices fall a lot. They go right back to where they were. An ExxonMobil might have some serious problems for a while. TPL's earnings go down, but it still has earnings, lots of earnings. And if its stock price falls, they'd probably take those earnings and buy back more shares because their shares are cheaper. They really are compounding machines. And that royalty model, that exists also in gold and silver. So I'll give you one more example, very short, because I have the statistics. Freeport-McMoRan we talked about. 24,000 employees. The free cash flow margin in 2020 was 12%. Not bad. Of course, the cumulative free cash flow over 3 years was zero because it's cyclical. Had some good years and bad years. Debt, 23% of assets. That's pretty good, not bad. The dividend payments over the last 5 years, relative to the share price 5 years ago, they've accumulated to 5% of the share price you might have paid 5 years ago. There's an iron ore royalty trust, believe it or not, called Mesabi Trust. It's very much like TPL. It has rights to royalties on this iron range in Minnesota, Minnesota is basically where iron comes from in the United States. So how many employees? 0. It's a trust. It has some lawyers it hires to make sure it gets paid and so forth. Free cash flow margin, just like TPL's oil royalty margin business, 90%. Debt, 0. Dividend payments the last 5 years as a percentage of the share price you would have paid 5 years ago, 109%. Meaning you got your entire purchase price back in dividends paid in the last 5 years. That's the difference between, in terms of inflation beneficiary, Freeport-McMoRan has to support 24,000 employees in terms of covering its operating expenses and all of its assets. Inflation on an extended basis can act upon its operating business and make it more expensive to do business. The royalty company doesn't have that problem.
To tie it all together, TPL, Texas Pacific Land Trust, it is not a part of the S&P 500, right?
No. It only recently, not so many months ago, became a corporation for the first time. So it became eligible this past year. It became eligible to actually be in indexes and ETFs for the first time, and actually is now probably in a couple of dozen indexes. It's got about, I don't recall exactly, but let's say roughly in the neighborhood of a $6 billion market cap. I'd have to check that. But it might be eligible. It actually could be eligible for inclusion in the S&P 500 one day. And that could well happen.
So Steve, a key principle in market cap weighted indices such as the S&P 500 is if the price of a stock goes up, more has to be put into it to balance it out. It's sort of watering the flowers and taking out the weeds. When you were giving your worries about passive vehicles earlier in our conversation, I sort of thought that that was part of your critique. You're saying, no, it should be more equal weighted. It should be more balanced. And yet, so it's Texas Pacific Land Corporation, if people can look it up, it was a huge winner, a generation of phenomenal returns, something like 20,000% returns over the past 20 years. And the sort of I'm not going to water my flowers. I'm gonna sell my flowers to water my weeds. Well, which is perhaps what Cathie Wood is doing with ARKK. Like she very into Tesla, but when Tesla goes up, they sell a little bit of Tesla and put it into the stocks that aren't working. You have not done that. You have Texas Pacific Land Trust is a large component of a lot of your ETFs that Horizon runs. Can you share why you did that?
I'm not going to get into, we have to have such a long discussion. You're probably tired of me already. I'm going to mention it, but we're not going to talk about the Bessembinder study. But that was a study that determined from like the 1920s onward that only 4% of stocks out of something like 25,000 stocks that were covered in the entire period ever outperformed treasuries. Okay. So number one, people aren't very good at guessing which stocks will do better on a consistent basis. But let me cut this short. I'll give you a shortcut. I'll give you two shortcuts. We've discovered, we're probably not the only ones. I know we're not the only ones. But we're one of the discoverers independently of a magic formula that is guaranteed to well outperform the S&P 500. And I'm actually willing to share it with you. And I'm willing to share it with you for free. We won't even charge you. And I'm not even going to ask for a royalty, although I should. But I'm not going to. And the reason I'm not concerned about it is because nobody ever does it. Certainly, I'm not worried about professional investors doing it because they're not allowed to. They can't do it this way. They get fired before it can ever happen. But all you have to do is select for the smart penny. So if you take, how do you know who's a good manager or not? It takes a long time to know. Maybe they hit upon a certain inefficiency and they don't even realize it. Or how do you know which is the best company? It takes a long time to find out. as a preface to that, I'll say, you talked about how wonderful TPL is done. And in fact, the first report we wrote on Texas Pacific Land Corp was in May of 1995. And on a split adjusted basis, the stock was $2.50 a share. Today it's about $1,200.
Extremely rare for an investor to buy something at a certain price and sell it 20,000% or realize it's something 20,000% later.
Now, however, you would think we would be happy about it. But I can tell you, TPL is just a headache for me because all I get is complaints. Believe it or not, all I get is complaints. If you look at a long-term chart and you look at it carefully, you'll see that there are quite a number of periods when either it dropped 30 or 40 or 50%, or when years went by and it was flat as a ruler and just didn't get up out of bed. And so what happens is, it's just a human thing, is clients, we have our portfolios and things are doing fine. And then 1 year, things are not doing fine. The portfolio is not performing as well as the S&P 500. And they're looking at it and they wonder why. Say, you got this big TPL position and it's down. It's down this year. And what are you going to do? You still want that thing? You still, so we get complaints, right? When things are down, but that's the nature of it. If we would have cut back or sold it every time it's down, we wouldn't own any. Okay. So to get back to the smart penny, there's an experiment you could do. How do you figure out which is the smart penny? So let's say you take 10 pennies and you just put them all down. And then you flip them all. You flip each one. And you want to select for the penny that knows to always come up heads. So you flip them and okay, you take away these three because they didn't come up heads. And you flip it again, you start with 100 pennies, right? You keep flipping. And finally, you're down to 2 pennies. You flip them both. One comes up tails, get rid of it. Now you have the smart penny, the one that always knows to come up heads. So is it really smart or is it just chance? Okay. So let's shift into making a portfolio that will outperform the market. So if you just select, it could even be random, but maybe you put some thought into it. But you put together a list of stocks. The only requirement is you have enough stocks so they can encompass what's called a normal distribution, just big enough so that chance can work on it. So you could see with the 10 penny example, it might not work so well. With the 100 penny example, it works better. It gives you more opportunities. But statisticians and mathematicians would say maybe 35 stocks is enough, right? But pick a range of stocks, so some kind of broad range of stocks. And then never touch them again. So I'm going to simplify it to a portfolio of 10, just to simplify it. You wouldn't do it this way. But let's say out of the 10, you've got 2 of them that are outliers on the downside. One's going to go down 10% a year. The other one's going to go down 15% a year on average. And they're just going to keep doing that. Then you have 2 outliers on the upside. One's going to go up 15% a year. The other's going to go up 20% a year. Actually, make them both the same. One's going to go down 15% a year. The other's going to go down 20. One's going to go up 15% a year. The other's going to go up 20% a year. And in between, you got the other stocks. They vary more or less around, let's say, the long-term average of 10% return. One's 11% a year. One's 9% a year. One's smack on 10. But the rest of them are in the middle. 6 in the middle. Okay. So at the end of year 1, right? So you put your portfolio together on December 31st. And by the next December 31st, at the end of the first year, what's happened? The portfolio has a return of a little less than 10%. Why? Because the 2 outliers went up 15% and 20% on the upside. The downside, the other 2 balanced it exactly. They went down 15% and 20%. And the others in the middle averaged to 10, right? So your total return is going to be a little less than 10%. But now we start on year 2. You start in year 2, the 2 that went down, and they all started equal weighted position. They all started with a 10% position. The 2 that went down are no longer 10% positions. They're a little less, right? One's 9 and one's 8 or something like that. And the two that went up, the outliers on the upside, they're like 11% and 11.5% or 12% positions. They're now a little bit larger than 10%. So for year two, the two outliers in the top, they're going to account for a bigger proportion of the return of the portfolio. And the ones on the bottom are not going to offset them exactly because they start off with a smaller percentage. They're going to get smaller. So in the third year, instead of being 11% positions, maybe the two outliers in the top, maybe they're 12% positions. And the ones that are going down, those are even smaller. And you carry this through enough years, 4, 5, 6, 7, 8 years, you'll reach maybe 8 years, 9 years, you'll reach a turning point, a turnover point, or a tipping point, when the ones that keep going down, they're beginning to become relatively immaterial. They go down each year, but they're so small now, it doesn't really bother you much. But the two that are outperforming, maybe they're 15% positions or 20% positions. The ones in the middle are the ones in the middle. And what's going to happen is the return of the portfolio, you can follow this through in your head, is going to ultimately begin to converge on the performance of those two outperformers on the top. And eventually, the portfolio will start producing, let's say, 12, 13% annual returns, even though the market's only at 10. Now, the reason why a professional portfolio manager can't do this, in part, is because we're taught to try to minimize volatility relative to the return. It's called the efficient frontier and risk-adjusted returns. And their portfolio manager held to very strict standards about that. But the portfolio, in fact, is becoming, in a way, more and more volatile because it's converging on the performance of the two biggest stocks. And really, it's uneven. They don't do 12 or 15% a year. Sometimes it's a 20% year, sometimes they're down. And the portfolio is becoming more volatile. It's becoming more concentrated. That's not good either. And it's becoming, by definition, in the investment world, more risky. And you won't be in your seat long enough to look back and tell your boss, you see, I was right. It works. You won't be there anymore. So it doesn't happen. And then we get to, if you're not professional, you got the best chance of doing this. But very few people have the patience. Because just like TPL, we've had clients with us for 20, 30 years. And even them sometimes, they say, well, how do you feel about TPL? I hear it's down a lot and, so forth and so on. And it's just, it's the nature of the markets. It's what makes markets. It's very difficult to be patient because you always think you have more information than you do. You think you made better decisions. We overestimate our capacity to make decisions. But that Bessembinder study, which is really startling if you've never seen it, is telling.
Yeah, it's fascinating. A lot of it's over my head. Stephen, I see some, not a lot, but some similarities between the lucky penny test, the one penny that is working and working. You want to hold that and not trim it down, to a market cap weighted index such as the S&P 500. Isn't Apple and Microsoft, aren't they the lucky pennies? And shouldn't the fact that they are, the 5, 6 biggest stocks are 20%, isn't it a good thing?
Eventually, though, if you want to go just in a simplistic statistical way like that, you look at this, and as soon as I mention it, I know you'll know. You'll know. There hasn't ever been a sector of the market that has gotten to be a dominant sector, like as oil did in 1980, become 30% of the market, in which the aftermath was really very unpleasant for the people who were there. It bespeaks of excess. The dot-com bubble. You couldn't convince people. I can't tell you how much we wrote about it. People got very angry at us for using the B word for bubble. And you know what? We were wrong for quite some time until we stopped being wrong. So valuation does matter. What we evaluate is that those companies are not only very, very expensive in any kind of traditional way, but if you look more closely at some of their finances and the way they construct their employee compensation expenses, for instance, that they're really a lot less profitable in one sense than they appear to be, meaning even more expensive. Then there are the issues that, and this is also an historical repetitive cycle. When you get to be large enough as a company, you start becoming a policy issue, either because you employ so many people and if there's unemployment or low wages, it becomes a political policy issue. Or it has to do with how much in taxes you pay. Or it has to do with antitrust issues. But you become large enough. It happened to Microsoft once upon a time, if you'll recall. It happened to AT&T. It happens over and over again. That's a separate kind of risk that you don't see on the income statement or balance sheet or PE ratio per se. There's the technological obsolescence risk. It's possible. I have this way of thinking like Microsoft. Bill Gates was known as being a very, very hard competitor, always pushing, always looking, maybe playing hardball, right? And I suspect, I'll say, you know what? I think maybe he understood. By the way, the MS-DOS, Microsoft Disk Operating System, do you know that was originally called a QDOS? Do you know what that stood for? Quick and Dirty Operating System. Because it was amazing. He actually got that contract from IBM to produce the operating system for the IBM PC. And he begged them for a little more time to work out all the bugs. And they said, no, you got a deliverable date, deliver it. And so I gather they worked very hard to deliver it on time, but it had bugs in it, which is why people's PCs kept crashing for years and years and years until they could fix the bugs. But that was just, I'm not doing it justice. It's a complex piece of programming, but in a sense, it was just an algorithm. It was a piece of intellectual property. And he came up with it. And I can't remember them all off the top of my head, but that MS-DOS, the PC, cut a swath of destruction through the world of global, large cap, blue chip technology companies that all went away. You haven't heard of them. Group Bull, Unisys, Commodore, Sinclair, 24 companies that were household names.
Never heard
destroyed them because in technology, unlike other businesses, they don't have any control over obsolescence risk. Somebody can come along with a better idea. And I like to think that, Bill Gates understood that just the same way he destroyed an entire industry with an idea, that, while he was building Microsoft, some guy could wake up one day in, Tel Aviv or Bangalore, India, wake up in the morning and go, oh, that's what I was thinking. And it's just an idea. It's an algorithm. And maybe that could wipe him off the map. That's one of the risks with technology that doesn't exist in lots of other businesses.
I was going to say, I think there are two features about passive indices that do not pass the lucky penny test. I want to hear your thoughts on it. Number one is that the S&P 500, the index construction as of now is not every single penny. It is, it has such a small fraction of gold miners, such a small fraction of energy. So it's not every penny. That's critique number one. Critique number two is that if only 4% of stocks beat treasury bills in a debate, then anytime you switch, and I've heard you say this before, so it's not my really original thinking, but anytime you switch, you have a 4% chance of making a wise allocation decision.
Now, when you want to let something get to be very big, again, you don't really want to drive blind, and you never want to give up. You have to be careful and judicious and self-aware about it, the opportunity to make judgments. But one of the reasons why we let TPL in individual accounts that we manage get so large is because of the reasons I mentioned. It has no balance sheet risk. It has zero debt. It's absent all these other various business risks I mentioned. And we continue to believe it's subjective, of course, it's far, far, far cheaper relative to, it's worth far, far, far more, we believe, on time than it's trading for now, still. As opposed to that it's beginning to reach a certain saturation point in terms of its marketplace or the development of its land or something like that. For instance, give you one fact that I want to make this about TPL. Only about 10% of all their properties have been explored. And of the parts that are explored, they're only partially explored. They're just getting going. And so it's at the very, in a strange way, I think it's more undervalued now because of the development of technology and the whole development of the area and how important the Permian Basin is to not only the U.S. Oil portfolio, but the global oil portfolio. I think TPL is actually cheaper today in ways than it was 6 years ago before it started its recent era period of appreciation.
Stephen, you've been extremely generous with your time and your insights. Thank you so much. I just have one more question, which is, you have the thesis about this bubble in passive vehicles. If this bubble were to burst, what would it look like? If you look at Horizon Kinetics, you can make money. Like, look at TPL. Like, you can generate returns by going across what you call the ETF divide without the sort of the bubble bursting. But if the bubble were to burst, what would that look like?
I don't know. But before I get there, I want to actually answer a not quite posed question. We're not against indexes. Indexes, at their heart, are a wonderful idea, and they can be very excellent tools even today. 2 examples. One is, and you kind of described it, there are a couple of extended market indexes, ETFs. I think Vanguard's got one, iShares might have one, which is, it endeavors to have more of the entire market in it, could have a couple of thousand stocks represented, and it endeavors to be more equal weighted across them than the major indexes are. It's still difficult, but they are more equal weighted. You do have more opportunity for, let's say, the middle portions of the roster of names to actually have success and not be crowded out of benefiting the entire index. And I found a couple of interesting indexes lately that I like. They have a special use. I'll give you 2. One, I don't use this. Someone else does at Horizon. There is an oil service company ETF. The oil service industry did far, far worse than the oil companies themselves, because they're the suppliers of services or equipment to the oil companies. They get cut back fast. And so they've suffered a true depression in the last half dozen years. So in an index, there are those that really failed, right? They're not coming back. But the ones that are still there, they stood the test. They really, they passed the existential risk test. Even at these low levels of activity, they up through last year, they were still cash flow neutral or cash flow positive. They're there. So if there's more development, a recovery in their area, they're so cheap. They could do very, very well. And that particular index, therefore, owns the best of them. And it is concentrated. There's nothing wrong with concentration per se. It depends. So that's a tool to use. And then there's another interesting one, the Crane shares with a K, Crane shares global carbon credit ETF. So there's an ETF that serves its purpose from my point of view. If you want exposure to carbon credits, right, do some good in the world, but it's an asset class that if, in math sometimes the symbol IFF, capital IFF, if and only if that does come to become an accepted asset class, it can be orders of magnitude larger. Final question was, how would, I frankly don't know. One answer is, it won't actually happen. It won't be a collapse because, well, so long as money comes in, but at a certain point, money can't come in anymore. So if money inflows stop, doesn't even have to be net outflows. Who's supporting the prices? Who's buying these shares? And the active managers aren't buying them. So what happens then? So you have to have a trade. You have to sell. But if there aren't buyers, maybe nothing happens. It sounds weird, though. I really think what happens is the terms of trade change. And those who would buy, they're buyers for Amazon, just at a lower price. And maybe just get discontinuity in certain sectors, right? And maybe the money flows into different sectors. Indexation's not going away. Maybe it evolves, maybe it changes, maybe there are better indexes developed. INFL, we think, is a better index. On the other hand, the sum total of the available market cap of all those wonderful companies in that particular, in our opinion, in that particular ETF, it's a thimble. It's a thimbleful. There isn't enough market cap, even if people are interested in buying it, to satisfy the enormous scale of index money. I think the money's kind of trapped there. I think it's trapped there, and I think what will happen is that it doesn't have to be a collapse. It could be that 5, 10, 15 years goes by, 20 years goes by, and little by little by little, there are the ups and the downs, there are patterns, there's the anthropomorphizing of the market. Oh, it had a surge, it took a rest, it's recovering, and people wait and wait and wait, and after 10, 15 years, they'll realize, hey, it really hasn't gone anywhere, and that the market gets cheaper that way. I just don't know. I guess I'll have to wait for the late returns, like an election.
Stephen, it's been fantastic having you here. Thank you so much. By the way, I just want to say we're recording this on Wednesday, December 15th. We're going up on 2 hours. We started at 1 p.m., about 3 p.m. now. So we're talking about these, what I love, Stephen, we're talking about these long form issues, very analytical. And we were not paying any attention at all to the Fed Chair Jay Powell's speech, which is sort of because when we first talked, we talked about how there's so much focus on, this happened. There's so much sort of chatter, so much narrative, so much moving around and positioning. But I really like that we prioritize the long-term analysis over that.
I'll just say one last thing. I enjoy this very much. But before I say that part, I'll say I warned you in advance, and I reiterate it now. I told you I'm an inefficient speaker, and I apologize for that. I heard Lynn Alden the first time speak. When you called me up, and I thought, let me see what you do. And I saw your first podcast with her. Now she's an efficient speaker. I really envy I really envy the way she communicates.
I think you're a good communicator too. And yeah, Lynn is fantastic, and I'm glad that you two have mutual respect for each other.
Well, thank you very much. It was great.
Thank you so much, Steve, and thank you to everyone watching.